The stronger economic growth we've been seeing has led developed economies to absorb their excess capacity. That naturally reduces deflationary pressure and leads them to think about tightening monetary policy. That means that exit is going to be the word for the rest of the year, not Brexit or Grexit, just exit. That means that developed markets will begin to end this exceptional policy we've had in recent years. Now, there's going to be no rush for the exit. They don't want to undo the recovery they've carefully put in place recently, and the lack of inflation is also a reason to go carefully, but the direction is clear. The Fed's going to lead the way, just as the US is leading the economic recovery. Of course, rates are already heading up there, and the balance sheet is likely to start to tighten from September. Even so, it's going to be another 2 years before rates in the States are back to neutral. Now, Canada is already hiking, following America. Australia may be 6 months behind them. In Europe, the ECB will soon announce it will taper asset purchases in the first half of next year. That will open the way for rate hikes before the year end. Bank of England is much more confused, just like the politicians in the UK. I think Brexit means that they will err on the side of caution. In Japan, inflation's barely positive. That means they're going to be at the end of the tightening queue. Usually we'd worry about developed economy tightening on effect on the emerging markets, but they look quite robust. I think we only have isolated problems in 1 or 2 countries. And remember, we're not just looking at interest rates. We have to consider overall financial conditions. That's asset prices, volatility, exchange rates. That all affects policy. So in America, looser financial conditions since the start of the year, despite rate hikes, mean that the Fed is going to have to keep on tightening policy. Unavoidably, there's going to be some apprehension. Of course, the backdrop of recovery from the financial crisis was this tremendous monetary policy support. But remember the predictions of doom we had around Fed tapering in 2014 and rate hikes in 2015. None of these came to pass. Also remember that policy is still loose. Abundant liquidity and interest rates well below zero are going to be with us for several more years. But a new phase of monetary normalization is beginning, naturally following the economic normalization we've seen in recent years.
July saw a continuation of some of the themes that we had identified previously, with some modifications here and there. The US dollar has been weakening across the board against the major currencies, euro and sterling. US bond markets have showed some signs of nerves occasionally, but volatility in the broader sense has gone from low to even lower. More and more market commentary is focusing on extended valuations in several areas, fixed income, possibly in equities, but in the absence of a clear trigger to reduce exposure, we maintain the view that we want to remain invested in markets, albeit with a degree of caution. We look first at high yield, and we find that it's a prudent move right now to reduce some of the more risky exposures in favor of higher quality names. In particular, we think there is reasonable value in higher rated the BB bonds compared to single B rated issuers, where the risk-return relationship has become less favorable. Overall, we choose to remain invested in this sector. In the case of investment-grade bonds in emerging markets, valuations are far less compelling, and we choose to reduce weights to the sector in favor of an increase to hedge funds. This is in line with our view that a well-selected portfolio of hedge funds will add a good degree of diversification to a portfolio without impairing return. It is a relatively low-risk addition to a portfolio and comes without an overall increase to market exposure. The call is in effect risk neutral at the portfolio level for clients that already have well-balanced portfolios. Equity market exposures were left alone this month. We are still invested in US and European markets. Despite a lackluster showing from May onwards, we maintain our view on Europe that the worst is behind us from an economic growth point of view. Overall, we leave our stance on equities as before. We are not advising adding exposure. Instead, we continue to look for interesting opportunities to rotate and also look at laggards or overlooked themes.